Today we're diving into a wild world of leveraged bets and inverse returns. We're talking about the SOXS ETF, also known as the Direxon Daily Semiconductor Bear 3X Shares ETF. Now, that's a mouthful. But trust me, understanding this guy can be a game changer if you think the chip shortage is about to fizzle out. SOXS aims to profit when the semiconductor industry goes down. But here's the catch, it uses leverage, meaning it amplifies your returns, good or bad. So, you can potentially make serious bank if those chip stocks crumble. But be careful, because if the market goes the other way, well, let's just say your portfolio could take a nasty hit. Don't worry, we're gonna break down all the risks and rewards of SOXS, along with some alternative strategies to hedge your bets. By the end of this video, you'll be a semiconductor shorting savant. Or at least know if this ETF is right for you. Question 1. What is the underlying index that SOXS ETF tracks inversely? The SOXS ETF, or Direxon Daily Semiconductor Bear 3X Shares, doesn't directly track an underlying index. Instead, it aims to deliver an inverse return, specifically -3 times the daily performance of a modified market cap-weighted index. There have been some inconsistencies in information about the exact index it references. Here's a breakdown. Historical references. Some sources, like older articles, might mention SOXS tracking the NYSE Semiconductor Index inversely. This was likely true in the past, but it's important to rely on current information. Current information, according to Direxon, the ETF provider themselves, and corroborated by other reliable sources, SOXS currently seeks to track the inverse performance of the ICE Semiconductor Sector Index. Key points to remember. Inverse relationship, SOXS aims to profit from a decline in the semiconductor sector. If the index goes down, SOXS goes up, by a multiple of 3. Conversely, if the index goes up, SOXS goes down, by a multiple of 3. Daily rebalancing. It's crucial to understand that SOXS rebalances its holdings daily to achieve its target leverage. This means the specific companies it holds might differ slightly day to day, but the overall objective remains tied to the chosen index. Further considerations. Leveraged ETF. SOXS is a leveraged ETF, meaning it uses financial instruments to magnify returns, both positive and negative, compared to the underlying index. This magnifies potential gains, but also amplifies potential losses. Short-term focus. SOXS is designed for short-term bets on the semiconductor sector's direction. Due to compounding effects, holding it for extended periods might not deliver the expected 3x inverse return. Question 2. How does SOXS ETF achieve its daily 3x inverse leveraged returns? SOXS ETF achieves its daily 3x inverse leveraged returns through a combination of financial instruments and daily rebalancing. Here's a breakdown of the mechanics. Financial instruments. Swaps. SOXS likely enters into swap agreements with one or more counterparties. These swaps act like contracts where SOXS agrees to pay the daily return of the ICE Semiconductor Sector Index, the benchmark, in exchange for a return based on the desired leverage, 3x inverse. Futures contracts. SOXS might utilize futures contracts to gain leveraged exposure to the semiconductor sector. A futures contract obligates the holder to buy or sell an underlying asset, in this case, an index or basket of semiconductor stocks, at a predetermined price on a specific future date. By strategically entering into short futures contracts, SOXS can profit from a decline in the index price. Short positions. In some cases, SOXS might directly short certain semiconductor stocks or ETFs that track the index. Shorting involves borrowing shares of an asset and selling them immediately, hoping to repurchase them later at a lower price and return them to the lender for a profit. This directly profits from a decline in the stock or ETF price. Daily rebalancing. The key to achieving the target 3x inverse return lies in daily rebalancing. Throughout the trading day, the fund monitors the performance of the index and adjusts its holdings in the financial instruments to ensure the portfolio's overall return is as close as possible to -3 times the daily change in the index. For example, if the index falls by 2% on a particular day, SOXS would aim to deliver a return of +6%, 3 times the inverse. The fund managers would achieve this by adjusting the swap agreements, futures positions, or short positions to capture the desired magnified return. Question 3. How does SOXS ETF perform in different market environments? SOXS ETF, or Direxin Daily Semiconductor Bear 3X shares, is designed for specific market environments and exhibits contrasting performance depending on whether the semiconductor sector is bullish or bearish. Here's a breakdown of its behavior in different scenarios. Bullish market. Negative performance. When the ICE Semiconductor Sector Index, the benchmark SOXS tracks inversely, experiences a positive rise, SOXS is designed to deliver a return of -3 times the daily increase. This means SOXS's value will decline as the semiconductor sector thrives. Example. If the index rises by 2% in a day, SOXS would aim for a return of -6%, 3 times the inverse. Bearish market. Positive performance. Conversely, SOXS thrives in a bearish market where the index falls. If the semiconductor sector declines, SOXS amplifies those losses, translating into gains for the ETF. Example. If the index falls by 3% in a day, SOXS would aim for a return of +9%, 3 times the inverse. Neutral market. Potential for erosion. In a stagnant market where the index experiences minimal fluctuations, SOXS might see its value erode over time due to factors like fees and compounding effects. Daily rebalancing ensures the targeted leverage ratio is maintained, but these expenses can eat into returns, especially in sideways markets. Key considerations. Volatility amplification. SOXS is a leveraged ETF, meaning it magnifies gains and losses. While it offers the potential for amplified returns in a bearish semiconductor market, it also exposes investors to magnified losses if the market goes up. Short-term focus. SOXS is designed for short-term bets on the direction of the semiconductor sector. Due to compounding, holding it for extended periods might not deliver a perfect -3x inverse return of the benchmark's overall performance. Fees and expenses. The fees associated with managing SOXS can further diminish returns, particularly in volatile or neutral markets. Daily rebalancing. The key to achieving the target 3x inverse return lies in daily rebalancing. Throughout the trading day, the fund monitors the performance of the index and adjusts its holdings in the financial instruments to ensure the portfolio's overall return is as close as possible to -3 times the daily change in the index. For example, if the index falls by 2% on a particular day, SOXS would aim to deliver a return of +6%, 3 times the inverse. The fund managers would achieve this by adjusting the swap agreements, futures positions, or short positions to capture the desired magnified return. Question 4. What is the expected holding period for SOXS ETF? Is it suitable for long-term investors? SOXS ETF, the Direxin Daily Semiconductor Bear 3X shares, is designed for a short holding period and is generally not considered suitable for long-term investors. Here's a breakdown of why. Reasons for short holding period. Daily leverage reset. SOXS utilizes leverage to achieve its 3x inverse daily return. This leverage resets daily, meaning the strategy focuses on capturing short-term movements in the underlying index, ICE Semiconductor Sector Index. Compounding effect. Due to compounding, holding SOXS for extended periods can deviate significantly from achieving a perfect -3x inverse return of the index's overall performance. Oh, imagine the index goes down 2% one day and then up 2% the next day. Over those 2 days, the index would be unchanged. However, SOXS, due to compounding effects of daily leverage, might not perfectly reflect a zero return and could experience a small net loss. Fees and expenses. SOXS has fees associated with managing the complex financial instruments it utilizes, swaps, futures contracts. These fees can erode returns over time, especially if held for long periods. Implications for long-term investors. Unintended performance. Long-term investors hoping for a -3x inverse return of the semiconductor sector over years might be disappointed due to compounding effects and fees. Volatility drag. SOXS amplifies daily volatility, which can create unnecessary drag on returns, especially in sideways or slightly positive markets, over extended periods. Higher risk. Long-term market outlooks are inherently uncertain. Holding a leveraged inverse ETF, like SOXS, exposes you to potentially significant losses if the semiconductor sector unexpectedly thrives over the long term. Alternatives for long-term investors. Inverse ETFs with longer focus. Some inverse ETFs target longer-term inverse returns, e.g., weekly or monthly, and might be a better fit for investors with a longer horizon, although they still carry inherent risks. Direct short selling. Experienced investors can consider directly shorting semiconductor stocks or ETFs, but this strategy requires a margin account and comes with significant risks of unlimited potential losses. Sector puts. Purchasing put options on a broad semiconductor ETF can offer some downside protection if the sector falls, but comes with option expiration risks and upfront costs. Inverse mutual funds. There might be some actively managed mutual funds with an inverse strategy towards specific sectors, but they typically have higher fees than ETFs. Question 5. How does volatility decay impact the returns of SOXS ETF over extended periods? SOXS ETF, the Direxin Daily Semiconductor Bear 3X Shares ETF, is particularly susceptible to a phenomenon called volatility decay when held over extended periods. Here's a breakdown of how volatility decay impacts SOXS's returns. Understanding volatility decay. Volatility decay refers to the tendency of leveraged inverse ETFs like SOXS to underperform their target inverse return, in this case, -3x the daily return of the ICE Semiconductor Sector Index, over extended periods, even in a declining market. Mechanism of decay. SOXS relies on daily rebalancing to achieve its targeted leverage. During periods of high volatility, these daily adjustments can cause the ETF to miss out on capturing the full inverse return. Oh, imagine the index significantly declines one day, followed by a smaller rebound the next. SOXS might perfectly capture the initial decline through rebalancing. However, during the rebalancing might cause SOXS to lose more than the index regains, resulting in a net loss for the ETF over the 2 days. Compounding effect. These minor tracking errors due to rebalancing compound over time, leading to a greater divergence between SOXS's returns and the perfect -3x inverse return of the index, especially in highly volatile markets. Impact on long-term investors. Erosion of returns. For long-term investors, volatility decay can significantly erode the expected returns of SOXS. Even if the semiconductor sector experiences a long-term decline, SOXS might not deliver the -3x inverse return an investor anticipates. Example. Imagine the index falls by 1% each day for a month, around 20 trading days. In a perfect scenario, SOXS would deliver a return of +60%, 3 times the inverse. However, due to volatility decay, the actual return of SOXS might be closer to plus 50%, significantly lower than the expected outcome. Minimizing the impact. Shorter holding periods. SOXS is designed for short-term bets on the direction of the semiconductor sector. Volatility decay has a lesser impact on shorter holding periods. Understanding the risks. Investors considering SOXS should be aware of volatility decay and its potential to erode returns over time. Alternatives for long-term exposure. Inverse ETFs with longer focus. Some inverse ETFs target weekly or monthly inverse returns and might be less susceptible to volatility decay for long-term investors, although they still carry other risks. Direct short selling. For experienced investors, directly shorting semiconductor stocks or ETFs can offer inverse exposure, but requires a margin account and comes with significant risks.